Hi there, welcome to Kneppy Invest and welcome to another answer and reply video where I get to answer your questions and reply to your comments to the best of my ability. And before we have a look at your questions, I think it's time to buy a new mouse because my mouse is just not working. I have to use my standard Apple, whatever you call it, mouse, which I don't like at all. My Master, what's it called? Logitech MX Master 2S, which I do use. You probably won't be able to see it here, yeah. It's just not working now. It's not working. So it is quite old, and I think it's time to buy a new mouse. So I'll do that after I've recorded this video, I think. Anyway, so let's go to, oh, by the way, fun enough, yesterday I was going on a rant that people buy stuff that they don't need on Black Friday, and I received an email from Equity Story, and there was a really good deal. Well, maybe it's not, but there was a really good deal, Equity Story, and I signed up. It was Investor Plus, 1,297 or something like that, and I could have it yesterday at $99. So I thought, why not? It's only $99, and I did have a look at what they do deliver, and I thought, oh, this could be worth $99. Could be. So here I am ranting about people buying stuff they probably don't need, and I subscribed to Equity Story for $99 for the next year on something I maybe not need, but who knows? They do have videos. Every single day they release a video, like a technical analysis video. So maybe I can actually get stuff out of this Equity Story. You get a free trial. I'm not sure if I'll memberships. Yeah, so it's this one here. I do remember they saying, yeah, here we go. Daily 15, 20-minute trade watch podcasts, daily short-term technical fundamentally review trading ideas, two weekly podcasts, Sunday pre-market trading ideas and whatever. So I definitely wouldn't pay $5,000 for an investor club thing. Yeah, wouldn't do that. But for $99, I'm always willing to try something like that because who knows? Who knows if it'll be good? But I probably wouldn't pay $1,297. That's a little bit too much for something that I'm not sure I'm going to get that value out of it. Anyway, maybe in a year's time I will say differently. Anyway, so I did buy something on Black Friday, and I suppose it also pays to provide emails to people because I got it from an email, this deal. Anyway, let's go to a Jake Chart 2374 who says or asks, thoughts on GNDQ? I have no idea what this is. Something to do with the Nasdaq, from long-term DCA strategy who can tolerate risk and who is young. And Motivational Flavio says, if you're young, it's a no-brainer. Well, some might say I don't have a brain. And G, let's go to ComSec first. G, what was it? What was it again? GNDQ. Beta shares, Nasdaq 100 or equal weight. Okay, so it's like the Nasdaq 100, but this one's equal weight, not skewed towards the bigger companies. I actually don't mind equal weights for the ASX. I haven't really thought about the Nasdaq, but I could definitely see the attractiveness of this, particularly if you think some of the smaller companies in the Nasdaq 100 might grow at a greater rate than the bigger companies, which we all know the bigger a company gets, the harder it is to grow at rates that it has seen in the past. NVIDIA right now is doing something we probably have never seen before. The growth in NVIDIA over the last few years has been extraordinary. It won't continue. It won't continue. So I do see attractiveness of equal weight. And for me, the ASX, any sort of ASX 200 equal weight would be better than the non-equal weight. So I was going to have a look to see what would be in this, like the holdings, but we don't have to know what holdings in. Here we go. Shouldn't it all be the same? The percentage should be the same, you would think, because it's equal weighted. Oh, that's what I would think. Anyway, so all you have to do is have a look at the Nasdaq 100, which we could do right now. Let's do that right now. Nasdaq 100. Excuse me if my mouse is making a noise. I don't know how. Equal weight. I don't know how people just use the standard Apple mouse all the time. It's just not, what's the word where it doesn't really fit your hand. The mouse I do use, the Logitech Master MX Master fits your hand perfectly. This mouse is just horrible. I don't know how people deal with it all the time. Anyway, maybe it's just me. Actually, no, I don't really want the beta shares. All I want to know is what is in the Nasdaq 100. Nasdaq 100. What's the word? Members or something. Nasdaq 100 companies by weight. Just go to the Wikipedia. Why not? I wonder if this is in. Oh no, this is not going to be. Here we go. So you can have a look at the companies in this, and I would assume the vast majority of the companies in the Nasdaq 100 you've heard of, and I would also say the vast majority of these companies are growing at a greater rate. I'd like to see the returns of the Nasdaq. Actually, let's have a look at the chart. Over time, how the equal weighted has performed versus the non-equal weight. I'm assuming because it is fairly top heavy in the Nasdaq right now, the Mag 7 have outperformed the rest of the companies in the Nasdaq. I would say the non-equal weighted one would have outperformed the equal weight, and this particular ETF hasn't been around for very long. Only since, although that's the weekly chart. If you go to the daily chart, yeah, it's been around since March 2024. Hasn't been around that long. I would say, and going back to this question, long-term DCA strategy, who can tolerate risk and who is young. The greatest companies, I'm going to say right now, maybe be a little bit bold, maybe controversial, the greatest companies in the world will be found in the NASDAQ 100. Maybe the biggest companies will remain the biggest companies, although history shows that does not happen. And if history is true and we see history repeat or rhyme, the biggest companies in the world in, say, 20 years' time might be some of the smallest companies in the NASDAQ 100. But I'd say it's a really high chance that the biggest companies, the best companies in the future are in the NASDAQ 100 and will be, if they're not in there now, they will be there in the next 5 or 10 years, particularly with AI. We just don't know who's going to win now AI. So long term, I think this is, particularly if you're young, say if you're 21 years old, I think this could be a really good strategy, just dollar cost average all the time, every week, every month. And this could be a really good way to invest. And I agree with Motivational Flavio. If you're young, it's a no-brainer. Yeah. So that's my thoughts. I'm not doing it because I'm not the biggest fan of ETFs. I do prefer to buy individual companies. But for those who don't want to do that, yeah, DCA strategy is a good way to go. For those who just want to go surfing and stuff like that, yeah, dollar cost averaging, way to go. For in ETFs is the way to go, in my opinion. It's just opinion. It's just an opinion. It's not advice. Just acronym says Reese used debt for buyback. Huge red flag. 2 thumbs up for that. If a company is increasing the debt for buybacks, that's a huge red flag. I absolutely agree with that. Reese funded the buyback via a mix of cash and debt. I did not know that. I actually was listening to his podcast this morning saying share buybacks are the biggest, wouldn't say the biggest scam. Well, what was it? It was Pitchfork Economics. But there's been $1.3 trillion worth of buybacks on Wall Street in the past year or something like that. And this has led to greater disparity in not income, but wealth. It is leading to greatest disparity in wealth. And share buybacks were illegal up until 1982. And I think the argument is the reason companies are doing share buybacks isn't because they're cheap. It's because it's more beneficial for the owners and the larger shareholders. That's it. It's not beneficial for the economy, not beneficial for the companies overall, including shareholders, but it's beneficial for the biggest stakeholders. Maybe not the biggest stakeholders, but the biggest shareholders, the bosses, that sort of thing. Because a lot of their remuneration is based off share prices, and doing share buybacks and the reason it was illegal was because it was sort of as manipulating the market. And if you're doing a share buyback, you are actually decreasing the shares, and that should lead to a share price increase, everything else being equal. So, and there is a reason why maybe some management teams look at share buybacks as a good way to increase their own wealth. But that was their argument. I'm a little bit more going, I don't know. I think share buybacks can be a good capital allocation But if you're using debt to do share buybacks, I think that's bad. I think that's bad. Although in saying that, there is a cost of capital and a cost of equity. If the cost of, or maybe cost of debt versus cost of equity, if the cost of debt is less than cost of equity, maybe it's okay. So there might be some reasons this could be okay, but I do think it's a red flag. I did not know this. So you put this in quotes. So obviously they mentioned it in what I could do. There we go. I just Googled it, and AI Overviews just says REIT is funding its recent on-market share buyback of up to 35 million with a mix of existing cash and debt facilities. Is this a bad thing? I was going to say, is this a big red? Is this a big red flag? I just don't like it. Funding strategy, optimal capital structure. They mention here the situation is nuanced. While increasing debt levels during a challenging market can increase risk, it is a part of REIT's stated capital management strategy to optimize its balance sheet. Well, that's not about debt here. I'm talking about increasing their debt to do share buyback. It's sort of meh. So they are doing it. No, I'm going to say no, is increasing debt to do a buyback a massive red flag. When could it be good? Could it be reasonable? Okay, so they mentioned here funding a share buyback, increasing debt to fund share buyback is not necessarily a massive red flag, but it adds risks and can be a sign of trouble depending on the circumstances. I just want to know when it could be reasonable. That's what I want to know. When could this be a reasonable strategy, increasing debt to do a share buyback? And then they go through the same thing I was talking about. To reach an optimal capital structure, company might have low debt to equity, which I don't know about REITs. This can lower the weighted average cost of capital, something that goes over my head, which theoretically increases shareholder value. That's the main reason you might do a share buyback, to increase shareholder value. When shares are undervalued, sort of understand that route. If the company is significantly undervalued, then you could actually increase shareholder value by doing share buybacks, by raising debt, particularly if debt is cheap, I think. The company's management believes that shares undervalued, a buyback using debt can be a strategic way to capitalize on this mispricing and increase the shareholder returns. I probably would say REIT is not undervalued. However, last time I looked at a P ratio of 20. So signal confidence, that's a sort of way that could be manipulating when a company believes its stock is undervalued. Yeah, but again, I don't think REIT is undervalued when the cost of debt is low. I'm not sure if we can say that right now. Debt is really low. Limited growth opportunities, maybe that's true for REIT. When it could be a massive red flag. Yeah, so I probably lean into this camp. When it's a massive that it might be more of a massive red flag. Ignoring long-term investments, destroying value to boost executive compensation. That's the cynical side of me coming out, that this could be just risk management saying, hey, we could get something out of this. Personally get something out of this when the rest of the company and shareholders don't. Anyway, so I think it is a little bit more nuanced than just saying it's a huge, massive red flag. I think you do have to delve a little bit more deeply into it. But that's just me being a little bit more diplomatic, I suppose. For me personally, I would say it's a red flag. Okay. Stuart McRobert says, nice work, K-Man. I've never heard that before, K-Man. Do you think the ASX is getting to the point where we should be rotating to more defensive stocks? So staples, utilities, maybe telco, Spark New Zealand or Spark Telecom New Zealand is looking interesting and is a Telstra equivalent. I would struggle personally. This is just me personally. I would struggle to be heavily invested in defensive. By the way, this is Spark New Zealand, and I was trading this for a short period of time. I thought sentiment had shifted back here in July, August, but no, And when they released something negative, I can't remember exactly what, but you can see a couple of down days, that was a get out. And share price has dropped since then. So Spark New Zealand, not right. I'm not there right now just because of the chart, but you probably could argue valuation-wise, maybe. Well, it says PE ratio is 15.9, dividend yield 11.2. So this could be a value trap. That's sort of high dividend with that price earnings, meaning they might have had a bad year, but there could have been a one-off, which led to the PE ratio going down. So the question becomes, why is the dividend yield so high? So the market is expecting the dividend to come down. Now, in saying all this, I do own a few defensive stocks. APA, I would consider defensive. I am trading this right now. I also decided to, I think Horizon is a little bit more defensive. This has turned positive. What else am I trading right now that I would define as being defensive? Oh, at Atlas Eteria. And there might be a few others as well. So I actually do own a few what I would consider defensive assets right now, but I wouldn't rush in and add to it. And I don't think we're significantly well. The banks, because the banks are significantly overvalued, I do think that means the ASX is overvalued. But if you take away the banks, I'm not sure you could say the ASX is overvalued and we're heading for a bear market. In fact, with the return we've seen, or the bounce we've seen in the ASX and overseas markets in the past week, I think that was just a little bit of a blip, a little bit of a small correction. So I'm not interested just yet going this direction. And even if we do see a major downturn in the market, I probably even then wouldn't be that interested. So for me, most defensives are just trading stocks, and you own them when the value does look good. So both APA Group and Horizon, I bought those because the chart started to look good and I thought there was a good value. Like if I saw the Woolworths chart and it started to look interesting, I wouldn't buy it because I don't think Woolworths is good value. So this is their chart. I don't think this is good value. So P ratio of Woolworths is 20. If it's above 20, it's, well, it says 36.23. Again, I think that's because of a one-off. But even if there wasn't a one-off, and the dividend yield is 2.96. I just don't see the attractiveness of a company like Woolworths that's going to grow at inflation. The only way I could get excited about Woolworths is if I saw it really good value, like APA Group or Horizon. Okay, so that's just me personally. ZDS Jamina had a comment that got 5 thumbs up, so I had to include this, and it was nice for an ego. It's like an ego stroke comment. Great job, Kneppy. Keep it real. Yeah, although we could be in a simulation right now, which means this isn't real. So if I'm recording this in a simulation, then nothing is real. There you go. How do we know this is real? How do we know this is not a simulation? How do we know? Whole point of a simulation is to make it as real as possible. And who knows, maybe someone has developed an amazing simulation and we all think this is real, but it's actually a simulation. Anyway, and I'm pretty sure Elon Musk has one point said where it's 100% likely we're in a simulation. I don't know if you can ever say that, but did Elon Musk actually say that? Let's see. Did Elon Musk say we are 100% in a simulation? Let's see. On the basis of this paper, Musk has stated there is a 99.99% chance that the universe we inhabit is a computer simulation. There you go. Anyway, so keep it real. I will keep it as real as possible unless this is a simulation. Paulie says, hi, Kneppy, can you share your thoughts on Core Lithium? Yes, I can. And you know why I can. I'm trading Core Lithium right now. So this is one of a few lithium companies I've now added to my trading portfolio because it does look like potentially lithium has found a bottom. We have seen a little bit of volatility in lithium last week. So if you have a look at the Core Lithium chart, beautiful chart. So the exact time I got interested in this one was the 14th of May, 2025, when they did release something really positive. So that was the first sign. Share price on that day rose 35.62%. Share price did get above 10 cents briefly, but struggled to get above 10 cents for a while. I took a position below 10 cents, and then I sold out for a small profit, and then I got back in. I don't know why I did that, why I took a small profit in Core Lithium. Anyway, so because this was more of a longer term thesis that the lithium prices now started to turn, and we started to see a little bit more interest. And you can definitely see that in quite a few lithium companies. So this is one. So there's the volume. Look at the volume down there. Look at the volume last month or so. Really good volume coming in. A lot of volatility last week. 2 weeks, we'll say. Share price has been as high as 26 cents, as low as 20 cents. So you're going to see this. The run up from 11 cents up to the 20s was quite short. So you would expect a little bit of profit taking. But if you have a look at a lot of lithium companies right now, you're seeing a lot of really good charts coming out. So this is Pilbara. Beautiful chart for Pilbara. So this is one I do own. Lake Resources, share price the other day went up. Was it yesterday? It went up a lot. So that's look at the volume as well. So that's more of a speculative one. What was the other one? Liontown. How did I fit Liontown? Liontown Resources. This is looking really good. Looking brilliant right now. That's a beautiful developing chart. So I started paying attention to this one back in May. And we started to see a shift in sentiment, shift in the trend of the share price. That has continued. And what was another one? I'm not sure if this is lithium. For some reason, I do think it is. I'll go see. It's in my lithium watch list, but it's some of the lithium companies have been in my lithium watch list for many, many years, and they might have changed tact. And so I might have to, there we go, lithium carbonate spot sales contract executed. There you go. So this is another one that came onto my watch list as well. And then there's another beautiful chart. And this breakout happened in July. And look at the volume there. So if I was paying a little bit more close attention to this one, yeah, get in July, August, and you've done really well. Anyway, so other than that, I don't know much else about the company. So for me, this is just riding the lithium train. I'm not sure how long it's going to go for. It could go for the next 2 years, 3 years. But they did release something positive back, was it in May again? And yeah, so this is for me is not a long-term forever play. This is just more riding, sort of a trading stock. But they did release, updated restart, repositions, Finniss operations, updated Finniss lithium project reserve and resources, restart study presentation. Have a look at those. That did shift the sentiment in this company from negative to positive. And that's all that can happen. And we can see that in the chart. A definite shift in sentiment and trend in the share price. That's all it needs. And sometimes it takes a while for it to play out. And before that, you can just see the share price in a well-defined downtrend started to show signs of leveling off. The low in the share price was in April at about 6 cents. And definitely beautiful. This is a beautiful chart. And the upside is pretty high if, lithium prices keep on going up. But the company itself, I don't care. Just as long as they keep releasing good companies. Oh, that's me realizing that I put the wrong ticker code for ADRAD. And by the way, let's see if ADRAD did win. So I do have content. I did this yesterday. I do have a poll post. Which company will have the highest share price at the end of the week? And ADRAD had only 10% out of 50 people. So only 5 people chose ADRAD. And when I looked at this towards end of trading yesterday, ADRAD was the winner, but did it become the winner? So ADRAD share price at $1.05. These are all 90-cent companies. And just behind ADRAD, we had Alkane. Who won? Oh, ADRAD won. ADRAD won. The other 2 companies, MLG, actually went down during the week. Points, but yeah, so ADRAD, the winner. By the way, I had a look at the chart for ADRAD. This is a nice looking chart. Look at that chart. The one thing is the volume, you have these volume spikes, but the chart looks actually pretty good. All right, so let's move on. VBED says, good day, Kneppy. On a day that Takeover is announced for Monash, IVF and directors rejected, there was a news announcement today by the company reporting that over 500,000 shares in voluntary escrow will come out of escrow. Something fishy is going on. Is this a case of director about to sell out while the price is up? Well, if this, they've rejected the takeover. I have no idea who had shares in Escrow. Let's have a look. So here we go. Notification of release of restricted shares in Escrow. 511,000. The release of Escrow shares does not change the issue capital of the company, and 9.5 million fully paid ordinary shares remain held under voluntary escrow. I'd like to know a little bit more about that, but it's not a lot of shares. It's only 511,000. And it could be just a coincidence that this happened very close on the same day as they rejected this takeover bid because it's opportunistic or something like that. They believe that I saw something else interesting here. Where was it? Change in substantial holding from a Sol Pattinson. Sol Pattinson getting out? No, they've increased. Wait, who was taking over Sol? Who was taking over? Who wanted to take over this company? Because this is a massive increase. So who was taking over? Who wanted to take over? Let's have a look. Oh, it is Genesis Capital Investment Management, and that has something to do with Sol Pattinson. Okay. So, so this is Genesis Capital Investment Management. And if you have a look, in fact, they do mention WHCSP. Okay, so I should have taken a closer look at that. Sol Pats and Genesis Capital. Okay, so they want to take over Monash, and that was why there was that notice of change of interest. There you go. But otherwise, this escrow, I've seen this before. Once it was a massive deal. It was a really small company, a Chinese listed company. Their shows came out of escrow and the share price went down 80-90% because they all sold out. And what I think happened there, this was maybe 2016. What I think happened there was just some Chinese people wanted to get their money out of China, and this is how they did it. And that company eventually went off the ASX. I don't know if they went bankrupt, but I believe that company was a vehicle for Chinese nationals to get their money out of China. And because when these shows came out of escrow, the share price plunged. I'm trying to remember what that company was called. Sunbridge. I want to see if there's any sort of news flow on that. I want to see if I can actually go to Sunbridge, ASX. Shows shares out of escrow, share price plunged. I still remember this because I was following this company because it looked really cheap. See if there's any sort of a. And then this was a long time ago, almost 10 years ago. But the ChatGPT says there's nothing I can find about it. Anyway, this was a really small company. Would have made the main news, but I still remember the share price just plunging when these shows came out of escrow. So it can happen, but I don't think it happens all that often. I'm not sure if I go, something's fishy's going on. And the next thing to keep an eye on is if we do see any sort of directors selling out. We haven't seen that just yet, but it might happen. I am Ecar says, can you please do Uber stock analysis on Saturday's Q&A video? Here we go. I'm doing it. Uber. I'm wondering if Uber can be, I'll be honest with you. I have never, where is it? Here it is. I have never used Uber. And funny enough, I've looked at Uber once and I went, this is not cheaper than taxis. So same sort of thing as Airbnb. I looked at Airbnb, went, this is not cheaper than motels and hotels, and there's more things that can go wrong. So I've actually never used Airbnb and never used Uber because I've never seen it being cheaper. Anyway, doesn't mean Uber is not doing well because apparently a lot of people use it. Markup is 100. What I'm going to do now is I'm just going to have a quick look at this company. What I do is zoom in and just look at the financials right now, just to see if the financials make me think of this company as a high quality company or potentially high quality company. So revenue growth, really nice. So last 5 years, 35.4%. No shock there. Earnings per share growth at 14.4%. And I would assume the margins of this company have the chance to increase. Now, the other thing you need to know about Uber is there's a lot of stuff going on in this space, particularly when it comes to automation. There's a lot of automated taxis now in the United States, particularly Waymo, if not all Waymo, and they are expanding quite quickly. And that could affect Uber because eventually driverless cars will become much cheaper than Ubers and taxis. It's happening, people. It is happening. If you don't believe me, what do you call Robotaxis? Robotaxis USA right now. It's not Tesla, although if Tesla, here we go, 11 hours ago, Robotaxis are spreading across the US. Tesla Robotaxi fleet set to double in Austin next month. So I think Tesla is well behind Waymo right now. Can a robot get a ticket? I was just reading about this the other day, how they're just spreading, and they're spreading even quicker. This is I don't think this is Waymo, but Waymo is now going to snowy places, and other taxi places haven't even thought about that. So Seattle's not that snowy, but Minneapolis. So you can see most of these are in the south. And the reason they're in the south is because of weather and snow in the north. But now Detroit, Minneapolis, Seattle, and it's expanding really quickly. Here we go. Alphabet-owned Waymo is driverless in 5 cities with 15 more markets coming in 2026 and beyond. Uber and Lyft are gradually adding robo-taxis from Waymo. I did not know that. There you go. And other partners to their ride-hail networks in select markets. Tesla has a small robo-taxi fleet in Austin and San Francisco. So and there's other players as well. Amazon Zoox, Toyota-backed May Mobility. Didn't know all these. Uber-backed Neuro. So this is going to be, and one of the reasons why, what's her name? The Kathy, whatever her name is, who thinks Tesla is significantly undervalued is because of robo-taxis and autonomous driving. So I was thinking as I saw this question, what is the future for Uber? And yeah, that's my main thought. What is the future for Uber? There is a lot of uncertainty there. Anyway, so market cap is $178 billion. Wow. Now, according to this, gross margins 34.2%, operating margins 9.2%. I would expect operating margins to go up. Return to equity 1% and return on invested capital 4.1%, 5-year average. I would expect that to be above 10% now, maybe. It says here the PE ratio is 11. So there must have been a one-off. There's no way the PE ratio of this company is 11. Cash $9 billion, net debt minus 1.5 billion. So net cash. If you look at the financials, I think what we're going to see here is a brilliant increase in revenue. This is exactly what I want to see. So it's gone from 3 billion to 49 billion. And if they are able to benefit from automation or automated driving, their margins will go up significantly. But the big question I have is, who is going to benefit? Is Tesla? Is it going to be a few winners? Seems like Waymo is winning right now. But I think Tesla, if they do perfect it, they would be cheaper because they have less stuff, gadgets. Let's have a look at profit. Where is it? Here it is. So they've become profitable the last few days, or last few years. Profit has quadrupled from 2023 to 2024 and almost doubled from last year to this year, looks like. So the company has definitely hit that inflection point. I would love to see how or which segments they make profits. So they have mobility revenue, delivery revenue, freight revenue. That's interesting in itself. So mobility, delivery, freight. And delivery, you would assume that there will be automation in delivery as well. And freight, eventually freight will be automated as well. Robo trucks, that sort of thing. Most of the revenue comes from the United States, but they are global. They are global. So everything. So yeah, I would consider Uber to not be as in the same quality class as some of the Mag 7s, but just behind it. But there is a lot of uncertainty about this particular company. And I'd need to know a little bit more. And what you could do is have a look at maybe their last quarter. Just have a look at what they're doing, that sort of thing. Because I haven't really looked at this company all that closely. Partnership with NVIDIA. Okay, who's not doing a partnership with NVIDIA these days? I just want to say grocery and retail significantly expands our delivery opportunity. So just reading something like this can be really engrossing, really interesting to see what companies are doing. One of my main problems I had with Uber when they first listed is they mentioned a total addressable market being something ridiculously like $500 trillion or maybe even more than that. And they technically were right, but it's not a possible addressable market. They're saying if you look at all delivery, all driving in the world, what it costs, it's $500 trillion. That's their market. But yeah, it's not a reasonable market. There might be a better word to say it than reasonable, but it's not a realistic total addressable market. Anyway, so their total delivery addressable market is $12 trillion. Yeah, again, really? Yeah, really. Grocery and retail addressable market, 10 trillion. Food addressable market, 2 trillion. Yeah, it's technically right, but you're assuming every single delivery is done through your services, which is never going to happen. Anyway, so they're way more than just Uber trips, I suppose. In fact, still going up, but revenue, quarter-on-quarter revenue growth, adjusted EBITDA, segment details, mobility, delivery highlights, freight. Looks like freight's not growing. Anyway, I'd like to also look at any sort of what's happening there. Why can't I look at that? I want to look at that. Oh, it's locked up. Have I not signed in? I haven't signed in. That's why. It's sort of annoying. Fiscal.ai. Everything should be signed in. I do this. Anyway, here we go. That's better. I just want to say, it's a transcript. There's no slides. I hate when they do this. Just a transcript. I'd like to see what they're planning for the future, that sort of thing. Anyway, that's all I'm going to say about Uber. It's least profitable. I do have questions about the automation, the driving automation, because if Uber becomes a winner in this space, it would be cheap at these levels. That's all I'm going to say. But the question becomes, who's going to win this space? Now, there might be a few winners. Uber could be one of them. So it remains to be seen at this point in time. But they're moving in the right direction based off all the financials I saw. JH says, hi, Kneppy, did you release a video on the 22nd? Absolutely. Did I release a video on the 22nd? Absolutely. Content. Answer and replies. Date November 22nd. So there it is. That's the video I released on November 22nd. So typically I do release videos every single day. So you might have to find or search a little bit harder. I definitely release one. Trader Hooper. SRG Global, apart from being a good announcement, it was a very good informative announcement. Gave a good overview of the diversity of the industries they work for and the types of work they do. The reason I want to discuss this is because these are sort of announcements I did like or do like. So this was released on the 25th. I believe it was the 25th. Yeah. And yeah, so I really like when companies release announcements like this and they mention the divisions or just results, when they mention or break down the company into different areas or different divisions or segments or sectors, and also geographies as well. So they just mentioned here, blue chip clients across Australia, New Zealand, water, defence, transport, energy, industrial resources, health, and education. So this is a global company, maybe. We'll have a look at it in a second, but it's a diversified company. It's another one. And I also like when they break down customers. For instance, they mention Wesfarmers here somewhere. Yeah, Wesfarmers, 5-year contract with Wesfarmers Chemical. And yeah, so I do agree with Trader Hooper. I like these sort of announcements because it gives a really good insight to how a company's performing. And when it's diversified and they're performing really well, like SRG, it's a, yeah. My only concern about SRG is maybe there's a little bit too much interest in this company right now. P ratio is 36.56. So I think the time to buy this was way back when I started trading it. And then I got out, I took profits, and I should have done that. So I started trading this. Share price was below 90. I remember because I took part in a capital raising. Yes, so it would have been back in middle of 2024. I bought some shares as a trade. I also partook in the capital raising, and then I sold out, took my profits, and I shouldn't have done that because the share price has gone up significantly since then. And I could go back and, again, I do prefer trade in companies that I think there's good value, and I can see the path to share price increasing significantly. SRG Global, for the share price to go higher from here, they need to expand financially. And yeah, will the P ratio go any higher than 37? It might. But once it gets like 50, you are thinking the market's getting a little bit too excited, which is why I do prefer companies that look good value and the chart looks really good. Because there's two ways a company share price can go up significantly. And that is financial expansion and also multiple expansion. Multiple expansion is P ratio, or the market more willing to pay a premium for a company, more and more willing. Anyway, I just like what SRG Global did right in that announcement. Okay, VB Ed says, I watched a video last week by some channel which listed the top dividend stocks on the ASX. Their criteria was dividend yield of at least 4%. Now, the reason this is interesting to me is I only did this briefly, very quickly and briefly, is I did my own dividend screener, but I titled it income. And what did I use? I want revenue growth. I want a little bit of revenue growth, but not much. Well, it can be high, but at least 5% revenue growth, which means they're beating inflation. Dividend per share growth, I want at least 5% per year. I want my dividends to keep on growing, and also want a dividend yield above 4%. If a dividend yield's like 2%, not that interested, although I could be, particularly if the dividend per share growth and revenue growth is quite high. So I just wanted to see how many companies hit this particular filter. Now I can compare it to this video. Dividend yield at least 4%, which is what I had. History of reliable dividend paying, price increase of at least 5% last year. So that's me. That's the same. That's sort of similar to my dividend per share increase over a 5-year period, 5%. So mine is 5 years. Looks like this video they mentioned just the last year. 5-year price trend increase. Also looking at quality and momentum, which I don't really have. The number one stock was Fleetwood. With a 10% drop in share price today, Fleetwood is a buy. It is a bargain. Let's see if Fleetwood popped up on my list. So at the top of my list, funny enough, it's a bank. It's a few banks. Westpac, NAB, ANZ are all in this list. There you go. Now, the P ratio of all these three banks is quite high. So that would be the big turnoff. So we're talking about 17, 18. That's actually really high for banks. But banks did pop up. QBE, Origin, Bendigo Bank, Bank of Queensland, Metcash, National Storage. So it goes down the list. This is all listed by market cap. Fleetwood is not on this list. Oh, there it is, Fleetwood. There it is, Fleetwood. Fleetwood is in this list. It says the market cap is 152 million. Is that right? It seems really low. 152 million. I would have thought it was much higher than that. It says 239 in market index. Yeah. So just don't accept, whenever you see something like that, Fleetwood 152, it seems really low. So this actually does point out companies that are smaller companies, which is why I like this, that have nice growth, but also have a nice dividend and a growing dividend as well. And like Corvus is in this. But there's also a few companies here that I probably wouldn't invest in. Prime Financial is a company I do have a little bit of a holding in, and I do think it has a chance. It is cheap. Market cap is 38 million, which seems right, but they are growing. It's not the best company, put it like that, not the best company. And there's a few other companies here like IPH, meh. Elders, meh. Grain Corp, meh. Super Rio Group, meh. Anyway, so I'm not sure if Fleetwood. Let's have a look. Let's have a quick look at Fleetwood. Let's go back. Whether this could be a bargain. Let's have a. I would not probably consider this to be high quality. Revenue growth 9.1% over the last 5 years. That's actually okay. Earnings per share growth 38.3% over the last 5 years. So this company has seen a little bit of margin expansion. Margins have improved based off that, most likely. Market cap 237 million. So that's different than the screener. Unless the screener was like a year ago, I don't know. Gross margins 34.2%, operating margins 7.1%. That would be sort of a red flag. Operating margins fairly low. Return equity, return invested capital, 5-year average is really low as well. So I'd like to see or understand why return equity, return invested capital are really low. But it wouldn't be shocking if this sort of company has sort of a low return or a low quality metric. And I would define return equity, return invested capital as quality metrics. What else? Dividend yield 8.9%. That does seem high. Payout ratio 160.9%. Okay, I need to find out why. That could be just a one-off. And dividend per share growth over the last 5 years, it's 38%, which is fairly similar to the earnings per share growth. So those are linked. Looks like P ratio forward-looking 7.5. So that could be suggesting that the income this year might have been affected by a one-off. Okay, so I also like to have a look at this. I like to have a look at graphs. Revenue growth, actually not bad. Sometimes, on occasion, you see a bit of a dip. And let's have a look at income. Let's see if there was a one-off last year. Yeah, in fact, income, only 14.6 million. So you can see low margin. It's a low margin business. And I'm always a little bit wary of low margin business because so on occasion you will see bad years like 2022, 2016, 2018 when the company was loss making. In fact, half the years here they were loss making. So even though they have been seeing their revenue increase, they have been loss making. And I'm just wondering, where do you find the dividends here? Oh no, what I might do is have a look at this. Do they have a reliable dividend? Were there years where there was no dividend? So according to this, there was no dividend in 2016 maybe. And there was no dividend in 2019 either. So dividends aren't that reliable and they're all over the place. So some years really good dividends, some years really bad dividends. So that for me suggests the dividend yield for this company is not reliable. So probably not in the same camp as VB Ed saying this is a buy and it is a bargain. And for me, this would be more of a trading stock. Now, in saying all that, the share price did dip. That's a daily chart. Fell to a support level at $2.40 and then rallied off that. And that support level was created from the lows in July. Chart had been looking good for a while and maybe not so good now. If you have a look at the weekly chart, by the way, this is another probably dead giveaway that maybe long-term this is not a buy because back between 2004 2013, share price was significantly higher than it is now. So something bad happened to this company in 2013. Not sure what it was. I do remember this company back in 2012, 11, 12. I did have a look at it and not for very long. Share price had been trading in a bit of a range and looked like there was a bit of a breakout at 320 or above 280. So the longer term chart, sometimes I will look at weekly charts. So the weekly chart actually doesn't look all that bad. It does look positive. But they did have something go wrong with the CEO. Anyway, Sensei wants me to upload some vlogs on your personal channel showing regular progress of my house build. I'm not sure I'm going to do that. And the main reason is I'm not there very often. So I've only been there once in the last 6 months. So I do get photos from the builder on occasion, so that's all I really get. So I won't probably be doing any vlogs, but I will have photos. I'm more interested in doing, I haven't looked at my trip photos for 3 weeks or since I got back, or my videos, so I still have to upload some of those. Another thing, why don't you start recording these daily rundown videos at 4:15 p.m. once ASX closes, and not at 2:45, 2:50, and upload it 90 minutes later at 6:30? There is a reason behind that. I do like my afternoons to be free. I just like my afternoons to be free. And I do prefer recording, if I had a choice, in the morning. So right now it's 10:27 a.m. I do prefer recording in the morning, and so my rest of the day is free. And this is sort of like a compromise. So instead of recording these videos in the morning, I record it in the afternoon, say 2 p.m. And I just like recording at that time for these videos. And the other thing is, whenever I'm doing something, I prefer to be early, I arrive early. So for instance, if I took my dog to the vet and the vet appointment is at 2:30, I do prefer to arrive or leave at a time when, if something bad happens on the way, I still be able to make it on time. Nothing is worse than being late or having a meeting and the other person is late. Nothing is worse, or this is the worst one, or someone is taking over from you at work. They're supposed to arrive at 7:30 and they're late, and they come in and say, well, the bus was running a little bit late. No, no, no. You get the early bus. Always get the early bus. It's better to arrive at work a little bit earlier before your shift starts than arriving late for the person you're taking over. There's nothing worse when that happens. A couple of people that do that at work, and they blame it on, the buses weren't running or the train was late. That's no. I just find it's much better to arrive at work 15 minutes early, and then the other person can leave it a little bit early. That's great. Anyway, so that's just me. I just find it, if I do record a little bit later in the afternoon, something might go wrong. I don't know. And I just prefer my afternoons to be free. I think one of the reasons I prefer my afternoons to be free is I can go through the ASX today, have a look, that sort of thing in my own time. And sometimes I can take 30 minutes, an hour to do that, and I'm not rushed. I don't feel rushed. Anyway, so that's never going to happen, unfortunately, for you. It's just the way I am. VBA, I think I talked about this, talking about thoughts on Brookfield's proposed takeover of National Storage, Australia's largest self-storage operator. I wonder if Brookfield got the nod of approval from the FIRB, Foreign Investment Review Board. My thoughts on this takeover? Zero thoughts until I saw a few other companies. I think I mentioned this. Yeah, I did mention this, like HMC Capital, Digico Infrastructure REIT, the HCW REIT, Home, which is a really long-winded REIT. What's it called again? Homeco and Wellness REIT or something like that. Healthco, Healthcare and Wellness REIT. Share price of these companies popped up on news of this particular takeover because I do think they are probably cheap. Probably cheap. That's my own thoughts about it. I don't really care about this particular REIT being taken over. I don't really care that it might be Brookfield, where they got the new nod of approval from the Foreign Investment Review Board. I don't really care about that. Something I do care about is there are more and more companies being taken over on the ASX, and a lot of management teams are just willing to bend over and take it up the proverbial ASS from these takeover, even though I think a lot of them are being opportunistic. And it just boggles my mind when management just give in so simple, which is a reason why own a company who is run by an owner starter, the owner, founder owner, that's a really good company, because a founder owner isn't just going to give in, isn't just going to bend over like that. Sometimes they might, but they won't. More than likely they won't, because they have aspirations. Anyway, so I have zero thoughts on this takeover. Zero. I just found it really intriguing that a few other REITs, share price just took off after that. Well Travels is talking about some helium. I have not even thought about helium. Thanks for all the video information. A company, BNL, Blue Star Helium, is in the helium sector. I'm just going to have to believe you. I have not even thought about helium. have not even thought about the possibilities of helium doing anything significant in the future. What's the end cases for helium? Is it just used for energy, that sort of thing? I understand hydrogen, but what is the helium case? Now, first thing about Blue Star Helium, share price is below 1 cent. That is an instant turn off for me. I would not. I'm just going to do this. Since I have never really thought about helium at all, I am just going to, what is, what can helium be used for? Is helium companies good investment? Let's do that. See if ChatGPT understands what I'm talking about. Even though I spelled it helium wrong the second time through. Here's a clean investor-friendly breakdown of what helium is used for, why it matters, and whether helium companies can be good investments. Okay, so this is, I have never even thought about helium. MRI machines, 20-25% of global demand. Now, this is based off that ChatGPT is absolutely right here. And if I want to know if it is right, I'll just ask it for links. I need links. I need, where did it get this information from? So MRI machines, 20-25% of global demand. Helium cools superconducting magnets to 269 degrees Celsius or negative 269 degrees Celsius. No substitute exists today. Hospitals are expanding MRI capacity globally. Highly stable, must have demand. There you go. So I know a little bit more about helium right now than I did before this video. Semiconductor manufacturing, fast growing. Purging chambers, cooling during chip etching, maintaining ultra clean environments. As AI-related chip manufacturing grows, helium demand grows too. There you go. Fiber optic cable manufacturing, space industry, pressurizing fuel tanks, rocket purging, cooling. With SpaceX and satellite launching growing rapidly, this segment is expanding. Nuclear, cryogenics, superconductors. Is cryogenics a thing still? Wow. Leak detection, industrial uses, rare niche uses, deep sea diving gas mixers, high altitude scientific balloons. I actually did know that one. Military surveillance balloons. Yeah, knew that one as well. Supply side, in facts, investors should know helium is geologically rare. Helium must be extracted from natural gas fields with high helium concentrations. Supply disruptions cause massive price spikes. There you go. Helium journals often surge during shortages, which makes sense. Is helium a good investment? Sometimes, but it's very boom busts. Oh, and it tells how to evaluate a helium stock. Helium concentration in the reservoir, very good, above 1%, exceptional 2 to 10%, world class above 10%. Again, I like to know where that's got the information from. And it says here, ASX, TSX have many helium explorers. Okay, so let's go back to this comment. To what can I to what I can see, the ASX does not have any helium producing companies. They released the market today an update saying we're on track to deliver its first helium production in December 2025, only weeks away. Can a company like this pull back to 2020 highs, or is the outstanding shares the problem? Well, okay, based off the share price, either this company is valued really low or they have a lot of shares on issue. What was it, BNL? So let's have a look. 0.7 cents. 3.6 billion. Yeah, okay. So they have a lot of shares in issue and the market cap is fairly low, 25.22 million. So 3.6 billion shares on issue is getting to the point where I think it's a little bit too much. And I would prefer, when a share price of a company gets below 1 cent, to do a share consolidation. Funny enough, I did read somewhere where people hate it. They go, oh, shares, 3.6 billion shares on issue is no issue. And as soon as they do a share consolidation, share price is going to tank again. Well, I've seen the opposite. Anyway, if they do 100 to 1 share consolidation, you get the shares down to 36 million. So what they should do is 50 to 1 maybe. So get shares down to 72 million. Now we'll say 100, we'll do 100 to 1 and the share price immediately goes up to 70 cents. Anyway, Okay, so let's have a look at the chart for this one before we move on. BNL. That's the weekly chart. Let's have a look at the daily chart. Yeah, in fact, you can see now the share price has dropped a lot. Share price has been as high as about 7 cents back in July 2021. So share price has gone down 90% since then. Looks like it's found a floor, and the floor is about 4.4 cents. But again, for me, it's share price is below 1 cent. It could just go sideways here for the longest time. And you get a lot of pip traders here who just will buy at 0.6 cents, then sell at 0.7, then buy at 0.6, sell at 0.7, buy at 0.6, sell at 0.7, and then eventually they'll buy at 0.6, and it drops to 0.5, and they go, oh, I'm screwed here. You get a lot of those sort of traders, and they do exist. What else? 2020 highs. I didn't like the chart for this one. I'm going to go there. I'm going to go to ComSec and have a look at the 5-year chart. Yeah, it's the same one. So yeah, it's hard to see what the 2020 highs were because the chart is so terrible. So it looks like you're talking about 221 highs, 7 cents. Look, it has a potential. All these companies have that potential. The big question becomes how realistic. Development production update, facility progress update. What is helium prices at the moment as well? Let's have a look. It's interesting to look at a company you've never looked at before. First production is still projected for December 2025. Okay, so we'll just believe him. Independent helium exploration company focused on finding and developing new sources of lowest cost, high-grade helium in North America. Okay, I'm going to just ask, what are helium prices now? What are helium prices now? Okay, that means absolutely nothing for me. Okay, prices remain elevated. That's what I wanted compared to historical levels, reflecting tight supply chain risk and rising demand. So that could be good. If you like, yes. I'm going to say yes. I do like how ChatGPT asks you questions. Do you want me to do this? Do you want me to do that? Helium prices. It's not a chart. That's not a. I was thinking you're going to give me a chart, a graph. Oh, it says here public data is fragmented. Ooh, yeah, okay. I do know more about this. Oh, I'm going to ask Blue Star Helium. See what it says when I just put Blue Star Helium. So they raised capital in mid-2025 to fund development and build infrastructure, probably one of the reasons why the company has a large amount of shares on issue, particularly with that small market cap. What looks good, timing may be favorable, entering production, if all goes well, might soon move from speculation to producer, which tends to reduce risk. Helium fundamentals remain strong, large lease footprint, multiple prospects, low cost target due to location, major risk and weaknesses, very small company. I don't think that's a major risk. Almost no revenue yet. Well, we already know that. Dilution risk is high. Yeah. Helium concentration in some wells is modest at 1.52% helium concentration at State 9 well, while isn't high grade by some standards, market risk of volatility. Oh, yeah. And funny enough, I gave it my criteria for high quality, and it's saying because you define high quality as requiring revenue growth, et cetera, this company does not meet my requirements. So it's really good that ChatGPT remembers what I define as high quality. Okay, so I've just like to know more about outstanding shares in the micro cap sector or small cap sectors and how companies can turn back around to make profit in the market. Thanks, Kneppy. Okay, so for me, this is all about what they can do when they go into production. How much money are they going to make? And I have no idea. No idea. but it could be the turning point for the company. And maybe the market doesn't see it just yet. I am wary about the shares on issue and the share price. I do prefer less shares on issue and higher share price. And if they do need more money, the shares on issue are going to keep on increasing. If they have to go back to the market for more and more money, they will have to raise capital again. What you can do is go have a look at, they have a presentation. I like presentations, by the way. The most recent Appendix 5B, it'll tell you how much cash they have on hand. Is that enough? That sort of thing. So they raised $4.5 million. So they've, based on the cash balance and how much they raised, they've got $6 million or thereabouts. Is that enough? I don't know. It's not for me to know. Oh, funny, no, do they have, oh, wait. So they raised $4.5 million and it's already, cash on hand is already down to 1.9. So I thought they'd have way more, but they really needed that money. What did they spend all that money on? So it was 2.7 million on just operating and financing activities, no, investing activities. So investing activities, exploration, yeah. So they're not far away from needing another capital raising, it seems like. And I do like presentations like this, America's newest helium producer. In fact, I didn't need to ask ChatGPT about helium because they've got a lot of information here. Anyhow, what else? Do you think ECS looking like it's a buy, starting to become cash flow positive company once again after last few updates? This is a company I've been following quite a bit. Now, then they have been operating cash, ECS Botanics. So I'm pretty sure, again, the share price is below 1 cent, so I have no interest in this company at all. Now, there have been, or they also announced sugar-free gummies. Now, this company has been cash flow positive a bit on occasion. So the most recent Appendix 4C, this is one of the first Appendix 4Cs released in October, and they were operating cash flow positive, 142,000. But they've had these sort of quarters in the past, and receipts and revenue has been increasing, but they just haven't found any sort of leverage. So they haven't really expanded their free cash flow to where I want based off the increase in receipts. So it seems like they increase receipts and revenue at the same rate they increase their product manufacturing and staff costs. So they haven't found any sort of leverage just yet. And the share price just keeps on dropping. So for me, this is a wait and see story because chart doesn't look good. And even though they are operating cash flow positive, I think they need a little bit more proof for me. But definitely one of my watch lists as a possible, just a possible play, maybe in the future. Okay, so that's a long time spent on that question. Trader Who says, quite surprised you're looking for ideas on hot copper. It lasted 2 days, and the last 2 days I haven't even gone back to hot copper. Yeah, it didn't last long. And there was one thing I did like, and you mentioned it, Trader Hooper. Trader Hooper mentioned it. On the short-term trading threads, it is a sniper scan, and yeah, they do have good scans. That was one thing I did find positive on hot copper. They have some nice scans in one of their forums, and I believe, let's see if I can go to it. Hot Cooper, not hot copper. They do have a. Where's all the forums? They do have a day trading one. Is it day trading or short-term trading? I forget. They have a weekend lounge. They have some really good scans. I can't show you right now because I have no idea where it is. I'm not going to log in. There's no point in logging in. You can actually have a look to see if any of these are scans. Not. Maybe this one. No. And unfortunately, you have to log in to get the what do you call it? Yeah, I'm not going to do that. So the one thing I did like was some of these scans, but I also discovered some scans in what do you call it? TradingView. I'll show you scans I've discovered in TradingView, and I did not know Did not know these existed. If you go to my watch lists and hot lists, they have a volume gainers. I like volume gainers. So we can actually see, you can actually do this by different indices as well. So for instance, West African Resources had a nice volume day. But what I look for here is companies that have gone up in price, like SVL, Silver Mines Limited had a nice volume day. Doesn't look like they did. Oh, wait there, I'm the wrong. I have to go to now. Yeah, it is a nice volume day, but it's not what I'm looking for. But nice day in terms of price action and volume. Coronado, nice volume day, but that's to be expected. But the share price did pull back. European Lithium. I'd like to see a little bit of volume. So I'm not sure what their criteria is for high volume, but I think it should be a little bit higher based off what I'm seeing here. Yeah, it's not that good. Anyway, so that's one thing I did come away from the hot copper, just looking at it for 2 days, looking for ideas. It was just the scanners. Post after work, yeah. Thank you for that, Trader Hooper. I did find that. Deb Shaw says, no mention of Mesoblast. It went up 14%. I mentioned Mesoblast. I absolutely mentioned Mesoblast. And, you know, if you go to my content and have a look, it must have been on the 26th. Look, 1340 Mesoblast. So I did briefly talk about Mesoblast because they did release something in previous day. The share price didn't move, and the share price went up 14%. So I did mention it on that day. Yeah, they did mention it. They did have a positive announcement the previous day, and this could have been a delayed reaction, but I did mention it. Yes, I did mention it, Dev Shaw. Hi, Kneppy. Have you seen Vault Minerals share buyback and the selling of their gold hedges? What are your thoughts about it? No, I did not see it. Did not see it. The question becomes, with all share buybacks, why are they doing it? Vault to exit materially unhedged. They did a share consolidation, ASX code. What did they do? What was their name? Oh, okay. So they're doing a consolidation, and they haven't changed their name. They're just trading under a different ticker code for the time being. Do they mention why they're doing a buyback? So ideally, the reason they're doing a buyback is they do believe the company shares are undervalued. I have no thoughts about the hedginess, or what do you call it? Selling of the gold hedges. I have no thought about that because it could be positive, it could be negative. I have no idea. I have no idea about it. But the share buyback I do have questions about why they're doing it. So they must consider themselves they do mention here, they have a strong balance sheet and forecast strong free cash flow generation. Now, if they do consider, here we go. In addition to the settlement of its gold hedges, the company's ongoing capital initiatives include the share buyback program commenced in September, which provides it with capacity to buy up to 10% of its ordinary shares. The buyback underscores Vault's confidence in its outlook and provides an accretive mechanism to reward shareholders today through increasing a stake in a highly cash-generative business, building long-term value. Now, is this the best way to use capital? Acquisitions, or maybe buying cheap gold companies? I don't know. So they've gone through what they should have done, in my opinion. Capital allocation decisions are the most important role or job of management. So dividends, share buybacks, acquisitions, paying down debt. So they would have gone, hopefully they would have went through all these different things they could have done with the cash flow they're generating, and went, share buybacks is the best thing we can do for shareholders. But maybe it's the best thing they could do for management as well. And that's not a positive thing if it's not good for the overall company. I'm going to go back to see if they did explain why they're doing the share buyback. Let's go back a year. So it was in September. This is in August. Announcement of on-market share buyback. Did they explain why? Probably not. Let's have a look. They just mention balance sheet, free cash flow. It's just saying the same things as it did before. Okay, here we go. So Vault believes that shares are trading at a significant discount to both the peer group and value of its assets, and as a result, views a share buyback as a disciplined way to return capital. Now, if that comment is true, yeah, then this would be a positive thing. This share buyback is a clear signal of confidence. We see our shares as undervalued, and by acting now, we are both rewarding shareholders today and strengthening. Yes, so if that is true, and do I have any reason to doubt Luke Tonkin? This is true. This is probably exactly what you should do. This is when you should do a share buyback, or when companies should do it, when they are undervalued, because it does add value or create value for shareholders. It does, without doubt, But is it true? Should I do this? Should I do this? Should I do something silly? True or false? Hopefully it knows what I'm talking about. It just says Vault. Oh, no, they're not talking about Vault. No, true for Vault. True for Vault Minerals. Okay, so it says here, some analysis suggests Vault could be trading at a material discount to its fair value. That's a couple of sources there. A discovery alert says strong balance sheet, but they also give the not conflicting, but the opposite view. What undermines a true view or raises doubts? Not all valuation metrics agree. Some analysis show the stock is not a bargain or is fairly priced when compared to peers or based on earnings multiples. In mining resource companies like Vault, asset values and future cash flows are heavily dependent on commodity prices. A lower valuation doesn't always mean undervaluation. Sometimes the market's discount reflects real risks, etc., etc. My view, maybe, but treat with caution. Yeah, I sort of agree with that. Yes, I'm going to say yes. I always like when it says, if you like, I can pull up a full recent valuation comparison of Vault versus handful of its peers. Now, there is a chance that the management believe they are undervalued, but they're not, because I do think management will have a bit of a skewed opinion of the company they are managing. So, and I've seen this a lot when management says, oh, we are so undervalued, and in fact they weren't, because again, they're going to be biased and have a bit of a skewed opinion. It's been a while, ChatGPT, or ChatGPT 5.1. It's doing a lot of thinking. Lots and lots of thinking. Oh, short answer. Right now, I'd say false. They say they're at a significant discount, but current numbers don't back that up. Oh, that's pretty harsh. Okay, so they have quite a few companies here. Now, the question becomes, how true is all this? So, Ramelius looks really cheap. EV to revenue. In EV to revenue, there says solid, but not obviously cheap. It says Bellevue. It says still ramping up, metrics messy. Vault is not on some screaming low multiple, similar to Regis or PE. They go through different metrics here. Anyway, so that's the company's view, that they are management's view that they are cheap. But I don't know. Trader Hooper, where do you get your list of IPOs? I wait for them to catch my attention through announcements. If they don't do that, I don't bother with them, but probably should be a bit more proactive. So when I used to have a really good list of IPO websites, but quite a few of them have gone bye-bye. Like I forget now, IASX IPOs. So small caps had a really good one, but I think this has gone bye-bye as well, because they've only got 4 this year. So I don't think small caps, upcoming IPOs, and they had a list going all the way back to 2020 of all the IPOs and how they've performed. So I think small caps might have gone bye-bye. List Corp, so open, pre-open, close. So these are some of the upcoming IPOs. I try to remember the last time I looked at. I used to always look at small caps, and I don't think I can do that anymore. Yeah, I don't think I can do it anymore, which is sad because I used to look at this all the time to get all my IPOs. So I'm going to have to find some news sites, and it's just disappointing that. So the ASX will have a list of upcoming IPOs, but I don't care about upcoming IPOs. I care about recent IPOs and how they've performed. There used to be a really good one called 61 Financial. That's gone bye-bye as well. I'm trying to remember if there was another one. Yeah, it was this one I was looking at, Intelligent Investor. So this one, you can actually, they have a filter as well. So, yeah, so this was, I think, one I just looked at recently. And I do like offer close. No, listing. I wanted to list this by listing. And we'll go to the most recent one. So the most recent listed company was Black Pearl Group. And I did actually read about that, 28th of November. Before that, we had quite a few ETFs, which this could be useful for. And then before that, we had Karma, CARMA. And before that, we had Golden Globe Resources and then Advanced Energy. There it is. So maybe this is the new site I'll be looking at, because I did have a look at this recently. And when I found that small caps had gone bye-bye. And this could be okay because they do have the issue price, current price gain, which I do like. That's one thing I do like. You can see Karma's gone down 42% since it listed, and Advanced is up 2.5. And Black Pearl Group listed yesterday. There you go. And a lot of ETFs. I do like this because of the ETFs. So ETFS US Technology, ETF Magnificent 7, US Quality, iShares Bitcoin, that sort of thing. So maybe that's it, Intelligent Investor. Actually, the reason I do remember this is because it asked me to sign up before, and I think I might have done that. It was free. Jay Lank says Laserbond might be worth a look today. It appears to be climbing out of its funk. Yes, this one is on my watch list. I haven't looked at the chart recently. When I say recently, I'm meaning in the last few days. And yes, it's broken out above 58 cents. There you go. Chart is definitely looking better. This is definitely on my buy list. Laserbond. Oh no, dollar. Oh, my stopwatch. Okay, so Laserbond looks pretty good. And they did release something positive, if I remember correctly. And they released that on the 20th of November. Share price went up a fair bit on that day, and then all of a sudden a breakout. This is the definition of a breakout. Look at it. Look at it. Study that chart. Bradley McDonald's, QBE, HMC, SGP, AIA, TWE. Most of these charts look bad. QBE was trading this. It's turned negative. I'm just going to assume this is just a technical question. Yeah, QBE insurance chart looks terrible right now. And the chart looked good. And then they had a bad day on the 8th of August. Is that results? Share price down 8.8. That was a get out. And then they had another bad day on the 17th of October. Share price down 9.3%. So 2 bad days almost next to next. And this is a classic shift in sentiment and trend. Beautiful shift in sentiment and trend. And it's definitely in a downtrend right now. What else do we have here? HMC. This one, I won't say it's turning positive, but a bit of a rally the last few days. But I think it's going to take a lot of work for this to move back into an uptrend. And I think the rally on this is just based off what happened with National Storage. But a couple of nice few days, nice volume. And I think maybe the bottom has been reached for HMC. But I think there could be some more volatility. Share price could move into consolidation phase. Maybe. SGP, is this Stockland? SGP Stockland? Yeah, I have no interest in Stockland. I personally have very little interest in these sort of companies, and share price has pulled back. So if you think this is a good company, nice value, might be a nice buy and a pullback, share price has dropped over 10% since its highs. AIA, Auckland International Airport. If you like infrastructure companies, maybe this is for you. Chart-wise, meh. Weekly-wise, let's have a look at the weekly chart. Look at that. Maybe I could say and argue if the share price fell into this purple box, maybe nice buying. It's not there just yet. And what else do we have here? And Treasury Wine. This one I did have a look at the other day because the chart looks terrible. Now, if you have a look at the weekly chart, share price is at long-term lows. And we're talking about almost 10-year lows. Last time the share price was this low was back in September 2015, which is more than 10 years ago. So Treasury Wine currently is at 10-year lows. Weekly chart looks terrible. Daily chart looks terrible. What is happening with Treasury Wines? Still remember Scott Phillips saying, I'm in Treasury Wines because Chinese are going to drink more wine. Well, at this point in time, based off this chart, eek. Which it could be right, but they might not drink more Treasury wine. But what's happening? Is there value in Treasury wines? The market doesn't think so yet. They released something negative not long ago. 13th of October, share price dropped 15% and the share price kept on dropping. So no interest in many of those at all. Personally, Just Acronym says Cosol is down again. Yes, it just keeps on dropping. And I'm getting to the point where I'm going, I think the market might be overreacting to this. Share price down to 40 cents. Market cap down to $71 million. Is the market seeing something? They did release something negative on the 30th of October, down 16.8%, and the share price has plunged since then. But the chart looks horrendous. One of the reasons I do follow this a little bit more closely is because I did trade this, and I got into the trade. When did I get into the trade? I forget. It would have been probably late 2022. I'm trying to remember. No, that could have been Doug. No, I think it was Cosol, where the share price plunged one day and then it recovered immediately. Or maybe it's another company. I don't know. I know it doesn't matter which company that is. Share price of this company looks horrendous, or the chart looks horrendous. Just going to see, there was a company, it was either Doug or Cosol, and I did see in Cosol when the share price plunged on results or something, and then the share price recovered on that day. Yeah, here it is. Yeah, it's Doug. 28th of February 2024, released results, share price plunge, and then recovered all in one day. And the share price kept on moving higher, so it looked pretty good. And then sentiment shifted, and then it shifted again. Okay. LW Holdings, is CSL having a share buyback, and what would that entail? Do you know about this? Let's have a look. Is CSL having a share buyback? Oh, look, update, notification of share buyback or buyback. I'm going to go back 3 months. So based off this, they're doing a buyback because you can see it. Update, notification of buyback. So they have to do this almost every day, if not every day. So they have to announce to the market how many shares they bought back. And so far, so they've bought back. So what they do is total number of securities bought back before previous day. So how many shares they've bought back so far in this buyback period, plus how many shares they bought back on the day. So 46,000 on that day. And they've bought back 2.3 million shares since they started buying back shares. I actually didn't know this. And I'll be honest, it looks like they've been doing it for a while. I'll be honest, I have no problems with CSL doing a share buyback at these prices. Here we go. So they started doing it in August when they released results. Now, CSL did a share buyback many, many years ago, and I did not agree with it because I thought they were expensive. Now I do think CSL shares probably could be considered cheap, relatively speaking, compared to, say, the banks, because fairly similar PE ratio, yet CSL is going to grow significantly over the next 5 to 10 years, way more than the banks. So if I only bought one company in the ASX 20, CSL would be near the top of that list, if not the top. So they are doing a buyback. And what would that entail? Well, they're buying back shares. buying back shares. So shares on issue would decrease, and technically it creates value for shareholders because your one share buys more. No, your one share is a higher proportion of the company than it was before the share buyback. So you're only owning more of the company if you don't sell. That makes sense. Let's have a look at the chart for CSL. Now, one of the reasons a company might do a share buyback is they might think it will lead to rally in the share price. Well, that's not happened with CSL. Share price has dropped since they announced that. And the P ratio is at 19.66, which is just above the P ratio for the banks. And if you have a look at the revenue over the next 5 to 10 years, CSL revenue and profit will grow significantly. And the P ratio, not the P ratio, the dividend yield will actually increase as well. Dividend yield for this company is 2.43%. This company is attractive at these levels, but you just see how much negative sentiment can negative sentiment can drive the valuation of a company down. And one of the reasons why the company hasn't performed as well is because of the increase in the anti-vax movement in the United States. That's going to turn ugly eventually, and it's going to shift because vaccinations are really good. You know, if you go back 100 years, I was reading a story about 3 kids dying from diphtheria in like one day. And then there was a rush to get because there was a vaccine. This was going back, I don't know how long. And there was a rush to get the vaccine in heaps of towns around this one town where these 3 kids died of diphtheria in one day. There was a rush for vaccines. Vaccines are good. So the anti-vax movement is just weird for me because who wants smallpox to come back? Who wants smallpox to come back? Insanity. Anyway, and that's one of the reasons why apparently CSL was not done as well, because an anti-vax movement in the United States. Anyway. Okay. Just Acronym says Austin Engineering is looking cheap after downgrade. Says EBIT comes in at 30 million, NPAT 20 million, market cap 120 million, slightly below net assets, 6 times PE. So the market is saying if they did release a downgrade, this could be the first of many. Maybe that's what they're thinking. So they're doing a buyback as well. So revised financial year 26 guide. I can't remember this, but so it's a slight downgrade, or the EBIT guidance was a big decrease, 34 million from 40 to 46 million. So things are not going well for this company right now based off this. So this could be, just could be, a value trap. So let's have a look at Austin Engineering. According to Fiscal.ai, the P ratio is 4.8. That's based off last year's earnings. So, so if they don't decrease their profit all that much, yeah, it could be cheap. Revenue growth has been nice. Earnings per share growth has been nice over the last 3 or 5 years. So maybe they've hit a bit of a rough patch. Dividend yield, not that bad. Definitely not a high quality company. But let's just have a look. Reverse dates, that's what I want. I hate how they have put, you don't care about that. I was just about to go on a bit of a rant. So, yeah, low margins. You can definitely see this company profit can be significantly affected 1 year. So on occasion, profit just collapses, and then other years it's nice. In fact, this company had negative profit 2016 through to 2019. So the market is wary about this company right now. So it might look cheap, but the market is saying this is a value trap. That's what the market is saying right now when it comes to Austin Engineering. So the question becomes, is the market wrong? Is the market wrong with Austin Engineering? Chart looks horrendous, not surprising. And this company does go up and down in trends. Look at that, beautiful trend for about a year. Share price went from 25 cents to 70 cents almost. And now it's gone from 70 cents almost to 20 cents. So let's have a look at the weekly chart. Share price down. If the share price got to 12.5 cents, I'd be going, ooh. It's because it's historical lows. Well, long-term lows anyway. But the question becomes, is it cheap? or more bad times in store for this company. Is the market overreacting? Is the market wrong? I think I've already talked about HMC. Yeah, up to 70% in 2 days. At resistance line, make or break next week. Let's see that. Let's see this resistance line. Well, I didn't have that close of a look at this one. We'll have a look at the daily chart. Resistance. There is a bit of resistance. Yeah. I'd put it, yeah, it is. I'd agree with that. It is that resistance, the highs we saw back here, and the share price dropping a fair bit. So I definitely see a lot of people buying at these levels back between July and September. And yeah, that's resistance. It's the whole definition of resistance. All these shareholders who bought at high prices, or prices at these levels, and they see the share price popping up, they go, oh, it's time to sell out of this dog stock. Share price fell. It's a dog stock because the company's wrong, not me. I'm not wrong. I didn't make the bad decision. The company is making the bad decisions. So I agree with Just Acronym. It is make or break for HMC. I would say the chances are that the share price will pull back. Though the volume was nice on Friday. If there was weaker volume, I'd be more confident the share price would hit this level and then pull back. And then we're going to see consolidation phase. But yeah, I agree with Just Acronym, make or break. Oh, and final 2 comments. Live well within your means and don't buy crap you do not need, says Paul Stephen. Then when you actually need something, you can buy a better quality product that will last a long time. I can't disagree with anything. On occasion, I will buy crap I don't need, but that's rare. That is rare. I'm trying to see something in my room that I bought that I didn't really need. I suppose I just updated my phone, but I've had my old phone for a long time and it needed updating. What else? Deodorant? Well, I need that. It's just next to me here. Headphones, need that. Hydration pills, need that. Hats, clothes, need that. There is nothing here that I really don't need. Now, in saying that, I do like to buy these little plush toys when I go overseas. So it's a wolf. I've got a few bears. But I suppose I don't need those, but they're not crap. Anyway, so absolutely agree with Paul Stephen. And I think that's a problem a lot of people face right now is they don't live within their means. And we've seen these stories on occasion. People earning $250,000 and then complaining that they can't afford something. They can't live without their nanny or something, and they're going to be affected by a tax rise or something stupid. And you go, how are you struggling on $250,000 a year combined, or maybe one person? I have no idea. And Digi, last question. How does CAT, Apult, Weebit Nano, and AYA chart look to you? Let's have a look. What's AYA? Artria. I don't know much about this one. Okay. Nice chart. Nice chart. Fair bit of volatility recently. I don't know why the share price of this one has just gone bananas. Are they a mining exploring company? I'm assuming that is true. No, they are. Coronary artery disease uses artificial intelligence to improve detection and management of coronary, whatever that is, artery disease. So shows you I have not looked at this company at all. So there must be a story stock. But the chart, share price got to $4, pulled back to $2.80. The chart on Friday does look nice, but the volume was quite low. So the question becomes, yeah, the share price has gone on a really good run. Share price struggling to get above $4. Pulled back. Is this little pop up in the share price, is that sustainable? I don't know. I'm not bullish nor bearish about this one just yet. I definitely would have been bullish on this between July and later October, but what we're seeing in the share price action recently is a little bit meh, and we've seen some bit of selling on some of these big down days as well, which is, I think, a lot of profit taking. So Artria chart, Wouldn't be surprised to see share price pulling back. And I think this one is, I think the whole market's going to determine which way Artria goes from here. If we continue to see some really good buying in markets around the world, this could go above $4. If the share price got above $4, technically that would be sort of a breakout. Weebit Nano, less of a story stock. Now, I actually don't know if Artria is a story stock. Maybe they are selling something. Oh, Artery. They've released 2 presentations on the 20th. They do release a lot of presentations. So a cynical person would say they're going to do a capital raising, or they did a capital raising not that long ago. There you go. Now, the non-cynical person would say, I love presentations because it's they're marketing the company, and I'm in that camp mostly. Let's just see if they are a story stock. I am assuming they are. $8,000 in receipts. They're burning through a lot of cash, which is understandable. This company is pretty expensive. I'm just going to have a quick look at their most recent presentation. Where are they? I shouldn't be. No, you know, I'm not going to do this. I'm not going to do this because the question wasn't about the company. The question was about the chart. Yeah. So I'm not going to even look at the company. So chart looks okay, but not the best. Weebit Nano, yeah, this one is less of a story stock than Artria. Share price, again, pulled back significantly on that bit of a sell-off. Went from 560 to 340. That is a thing with story stocks, and even though Weebit Nano is technically not a story, they are selling something, you're going to see the share price be very volatile because it's really hard to put a valuation to these companies. If you ask me one day to value Weebit Nano, one day I might say one number, another day I might say another number. You might ask someone for valuation, they'll say 0. Another person might say $100 billion. So you're going to get a massive range of numbers if you ask to give a valuation because you don't have any tangible numbers. You don't have numbers. And to give a true valuation to a company, you need numbers. You need financial numbers. So in a lot of these cases, these companies are going to go up and down just on sentiment. So the share price did pop off the 100-day moving average. You could say that's positive, but it has struggled to get past the 25-day moving average. That's negative. So it might have found a bit of resistance at these levels. And all you have to do is have a look at the weekly chart to see that the volatility in this company can be off the charts. So for me, Weebit Nano, Artria, these are more trading stocks. And would I trade this right now? I'd say not for me right now. I would have been more interested back in July, late July, because there was a bit of a breakout then. And for Artria, I would have been more interested because I don't know which way the share price is going to go from here. And for Artria, for me, the breakout, there was a few breakouts for this one. So back in October 2024, and we saw liquidity and volume improve. And then also back in July this year, there was a nice little breakout, 3 days in a row, and the share price went sideways. I do like that sort of share price action, even though I'm not really following this company. That was nice for me. And when the share price got above $1, that was another really good sign because $1 was a bit of a resistance level for this company. And then got above that, stayed above. Look at that. You can see how long it took to really get above $1. So hit $1 back in January, then pulled back. Got very close to $1 in March, then pulled back. Got to $1 and then really struggled for about 3 weeks. And then it went bananas after that. And look at the volume coming in. So they must have released something really positive on the 21st of August. Share price up 38% on the day. That would have been a nice buying day as well, just after that as well. And finally, Catapult. So I was trading this. I'm completely out of Catapult. I can see this going, yeah, I can see this. It's had a nice bounce. For me, as soon as it fell below, there was moving average crossover. So share price fell below. That's a line here, about 560. That was a sell. Wouldn't be surprised to see the share price sort of get to this level and then pull lower. A lot of volume coming in on this little bounce as well. That's actually not a bad sign. But I do think we have seen the trend change. Possibly change. If we don't go into downtrend for this one, at least a consolidation phase, but definitely that trend I think has come to an end for Catapult. Okay, that's all I have for this video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.